We have heard a lot about risks in the last day. A myriad of risks. We have heard that our government is a risk. We have heard that our fellow citizens are risks. We have heard that Islamic terrorists are risks. We've heard that other cultures are risks. We've heard that our own culture is a risk. We've heard a lot about risks. But in terms of the application of your efforts in your own portfolio, the greatest risk that you are going to face is not, in fact, taxation. It's not regulation. It's not issuer fraud. It's not the clash between Islam and Christianity. It's not even peak oil. The greatest risk that you face as an investor, not as a human being, but as an investor, is conveniently located to the left of your right ear and to the right of your left ear. Quoting that great investor Pogo, we have met the enemy, and he is us. When you take in all of the risks that face you, it's the risk that you run yourself, not managing your emotions, not managing your intellect. It's the risk that you make a mistake that's a controllable mistake. George Soros, I think, put the investing process and the risks that we can control ourselves in, he crystallized them when he said that he had become a billionaire by finding commonly held precepts that were incorrect and betting against them. And there are a lot of commonly held precepts in the world that I think you can bet against, and I think you have to bet against in order to do well. We are entering into a period, in fact, we've entered into a period of the market now, which is going to go on for quite some time, I think, that is going to be punctuated by a whole bunch of stuff. But the most important thing in the near term it's going to be punctuated by is one word, which is volatility. Volatility, as is measured by the VIX, the volatility index, I think will be over 30 for a substantial period of time. That's basically unprecedented, except for parts of 2007, 2008. One widely held precept is that volatility is the same as risk, and it isn't true. There's another widely held precept that volatility is bad, and that isn't necessarily true either. Volatility refers to pricing, and I know from being a broker for many of you that almost nobody in the room objects to upside volatility. When stocks jump 30% for no reason, and they validate beliefs that people in the room have had with regards to the value of their portfolio, that's good. 30% increases for no reason whatsoever, that's wonderful. It's the downside volatility that seems to bother people. I don't know why that is. What is 30% decline? If you were going to a grocery store, if you were going to a department store, if you were going to a clothing store, that would be a sale. How would you like it if you were going to look for a car? Let's say that you decided that you wanted to have a Lexus or something like that, and you went to the car lot, and the Lexus that you wanted was, I don't know what a Lexus is, $60,000, something like that. And you went back 2 weeks later, and the Lexus was $40,000. Would that be a bad thing? Anybody here object to that? 30% off sale? For some reason, when small natural resource stocks fall 30%, it's bad. People want to sell them as opposed to buy them. And that's what I'm talking about in the context of the fact that the greatest risk that we all face is to the left of the right ear and the right of the left ear. The fact is that we have to regard volatility as an opportunity. If we don't take advantage of volatility, the markets will take advantage of us. This is an example of a widely held precept which is wrong, that we have to bet against. The only thing that we have to do to determine whether or not we take advantage of volatility or we are taken advantage of by volatility is operate, recognize the great risk that we face, which is ourselves, and act on it. We have very well presented before us a sense of where the opportunity is in the natural resources market. And so let's talk about the origins of volatility in natural resources. In the first case, part of the bull case for resources was, as I say, presented right before me. The decline in grade, the decline in margin, the decline in energy efficiency in extractive industries. Yesterday you heard Steve Yusby talk about the challenges that we face worldwide in agriculture and in water. So we have in resources, I think, a bull market that will go on for a substantial period of time. But it's going to be a bull market that is going to be punctuated by periods of extraordinary volatility. How many people in the room were gold bugs in the 1970s? Let me illustrate this volatility. Some of you will remember this, perhaps painfully. In the decade of the 1970s, the gold prices, you'll recall, began at $35. It ended the decade at $850. Pretty good run. Do any of you remember the fact that in 1975, the gold price fell from $200 an ounce to $100 an ounce? In the midst of the biggest gold bull market in all time, the gold price fell by half. It wasn't a secular decline in gold, it was a cyclical or volatile decline in gold. And there were people who, at the beginning of the decade, anticipated the fact that gold would run from $35 an ounce to some much higher number. And as a consequence of not being either financially or psychologically prepared for the volatility, they still lost all their money. Very, very, very important lesson. You must have liquidity and you must have courage to accept and profit from volatility, even in a secular bull market. The volatility specific to our industry, the resource industry, is a function, as I say, in the decline in the quality of natural resource assets. It's also a function of the fact that we entered a bear market in resources in the early 1980s, which continued to the earliest part of the last decade. There was about 20 years where society as a whole didn't invest in natural resource-based businesses because the margins were declining as a consequence of over-investments in the 60s and 70s. Remember that these are very, very, very cyclical, capital-intensive businesses. And so the situation that was described by the prior speaker, which is a decline in the quality of resources available, was exacerbated by 20 years of underinvestment in natural resources. That's the supply side of the equation. The other side of the equation is the demand side of the equation. As was again pointed out by the prior speaker, on a worldwide basis, population is growing, and at the same time that the number of capitas, that's people, increases, per capita consumption of resources is increasing. Particularly at the bottom end of the demographic pyramid, those 3.5 billion people at the bottom of the demographic pyramid, those people all want to live like you. And as they get more money, and by the way, they are getting more money, the bottom of the pyramid is becoming progressively more free, and as a consequence of becoming progressively more free, they're getting progressively richer. Commodity consumption is increasing per capita, and the numbers of capitas are increasing. This is very, very, very important. These are very, very, very important things to consider. So part of the volatility comes from the fact that I think that the resource sector will do better than other sectors in the economy. There will be bullish forces that will give you upside volatility. On the other hand, the broad economy, the political economy, the broad stock market, I think are in very, very, very difficult times. You know, people talk about asystematic events, black swans. If you were at this conference yesterday, you saw so many potential black swans that they resembled a flock. What could go wrong? Well, what couldn't go wrong? There were a whole set of circumstances that are suggested to have been responsible for the 2007, 2008, 2009 liquidity crisis that we experienced, and I personally don't see how any of them were addressed. As an example, Greece has a difficult time making payments on debt at 150% of GDP. Does anybody believe that increasing Greece's aggregate debt from 150% of GDP to 165% of GDP is going to solve the problem? And that's just Greece. So that's the nature of volatility. On the one side, you have extremely dangerous sets of asystematic events credit contractions, illiquidity, and on the other side, you have an incredible base of support for natural resource-based businesses. And think of it as two enormous weather systems. When these enormous weather systems collide, what happens? There's lots of turbulence and lots of volatility. And I would suggest to you that the most important thing that you can do for your portfolios for the next 2 or 3 years is, first of all, remember the thesis that on the supply and demand side, resources are going to be more and more and more valuable. But in the context of that, the financial market, the pricing associated with the equities of companies that control or are looking for natural resources are going to vary, and vary in extraordinary degree as a consequence of volatility. If you are the type of person who, when a stock goes from $1 to $2 for no reason, thinks that's good and buys more, this is the equivalent of a $60,000 Lexus that you're now buying for $120,000, you will not do well in this market. If you are a person who understands that he or she must use volatility and would rather pay $40,000 for the Lexus than $60,000